In this video, we will review accounting for notes receivable using the example of exercise 9-11 from chapter 9 of volume 1 of our textbook. Notes receivable are more formal than accounts receivable. The borrower or debtor signs a promissory note accepting the conditions of borrowing. The note also serves as evidence of the transaction. Note receivables may be issued in exchange for cash, in lieu of accounts receivable, or in exchange for accounts receivable. Remembering when working through a note receivable question that interest rates are always quoted as an annual percentage for 12 months or 365 days. In essence, interest revenue is our reward for renting our money out to someone else. With a note receivable, we include the accrual of any unpaid interest receivable as part of our period end adjusting entries. We need to disclose to the users of the financial statements all of our receivables, trade, and interest. In this example from the textbook, I've put the journal entries on the left and the raw data on the right. We have Tropical North Company, which has a December year end and uses a periodic inventory system. During 2019 and 2020, we've completed the following transactions. So what Tropical Company is doing is, instead of issuing accounts receivable, they are issuing the credit in the form of a note receivable to their customers. October 14th, we sold merchandise to OFTR Racing, receiving a 60-day 6% note for $5,000. October 14th, we debit notes receivable for the $5,000. We credit sales revenue for $5,000. Because we're using a periodic inventory system, we are not needing to relieve that transaction from inventory, but rather inventory will be adjusted at the end of the accounting period for this business. On November 16th, we sold merchandise to Sunrise Racing, receiving a 72-day 4% note for $7,500. Similar to the October 14th transaction, we debit note receivable, we credit revenue for the $7,500. With both these note receivables, we've received a signed document from our customer with a promise to pay within 60 and 72 days. At the time of repayment, we will receive, one, the principal amount of the note, but we'll also receive any interest that is accrued over that 60 and 72 days. On December 13th, we received the amount due from OFTR Racing. So it's been 60 days since October 14th. So we're going to receive the payment in full from that customer. We're going to receive cash of $5,049.32. We're going to reverse the amount of the note receivable because we've collected in full of $5,000, and we're going to recognize interest revenue of $49.32. That interest is calculated as our principal of $5,000 times the 6% times 60 of 365 days. Remembering that interest is always quoted on an annual rate, so we need to convert it back to the period in which we're working with. December 31st is our year end, but the Sunshine Racing note has not come due yet. Therefore, we have to accrue any interest receivable on that note from Sunshine Racing. Sunshine Racing has a note for $7,500 at 4%. And if we calculate the number of days from November 16th to December 31st, we calculate 45 days for an interest receivable of $36.99. On January 27th, 2020, which is 72 days after Sunshine Racing's note was originally issued, they have come forward and are able to pay the full note plus the interest in full. So we are going to receive cash of $7,559.18. We're going to reverse the entire note receivable of $7,500. We are going to reverse the earlier interest receivable of $36.99, but we have to account for the interest that we've earned from January 1st to January 27th. We take our note of $7,500 times 4% times 27 of 365 days to arrive at that $22.19. Remembering, our debits have to equal our credits. 1, we receive the note. Secondly, we receive the interest receivable that we accrued at the end of December. And thirdly, we account for the interest that we've earned from January 1st to January 27th, the sum of which we're going to receive in the form of cash from Sunshine Company.